My name is Laurent Bernut. I'm from New Caledonia, which is close to New Zealand. I was born in Wellington. I've been in the financial services industry for 18 years. Prior to that, I was an accountant, so I was a CPA, and I used to do consolidation. So consolidation for listed company, Japanese company, financial consolidation, managerial consolidation, transfer pricing, and all kinds of interesting accounting things. So I do understand fundamentals. In fact, I have a very intimate understanding of fundamentals, as we'll come to see later. So short selling is a survival skill. Now let's put ourselves into the shoes of investors. What do investors really want? I mean, like, there's a classic joke, like, what do okay, I want to know what investors want. Somebody walks up to God. I want to know what investors want. Oh, dude, do you have anything else? Well, I want a no, what do you want? I want a 4-lane highway to Hawaii because I don't like to take the plane. All right, and sorry, it's too tough. Can I know what investors want? How do you want your 4-lane? It's too difficult. Well, it's very simple. One simple thing that investors want, they want to sleep. They want this. They want the Madoff type of return. And this is why I call it the Madoff case. The Madoff case is Madoff managed to lull investors to sleep. Investors want low correlated returns over time. And Madoff did 3 things that nobody else did. It was always up for business, so there was no big drawdown. It was uncorrelated. And the final thing is that with this, it doesn't have to be big. Investors are not looking for big returns, they're looking for consistency. And this is something that is important to understand. And how do you do that? Well, through short selling. Now, markets are really noisy. You know, there's no shortage of creation. Like, there's tons and tons and tons of investment vehicles, but there's a big shortage of creativity in the financial services, which means that there's plenty of vehicles where you can park your money, but very few good vehicles where you can rest assured that things are going to work fine. By the way, if you have questions, go ahead. Start asking questions. So when it is time for asset allocations, how do investors think? You see, when markets are going up and up and up and up, people are quite happy. I mean, there's not much of movement. But on the other hand, every time the market tanks, what happens is those who still stand up stand out. So investors pay a lot of attention to months where markets are down, because when they see that the few guys are up, then it shows scale. And how do you get that scale? You don't get that scale by buying high dividend stocks. You get that scale by being a short seller. That's it. So the key to raising AUM, if you don't believe me, the key to raising AUM, ask John Paulson, ask Heinhorn, ask all the guys at the Big Short, all the guys who can make money on the in down market. The phone rings off the hook. Those who don't make money in down markets, well, guess what? They go the way under the door, and they deserve it. So, which leads me to supply and demand. Now, think about your career. There's ample supply of people who want to buy. There's ample supply of these guys. The other day I was talking to a friend of mine. He's a 50-year-old broker, and he said, yeah, but I'm a stock picker. And I told him, yeah, but you're obsolete. If you didn't get the memo, it's because nobody uses fax anymore. You're obsolete. You can't code, and all you do is find small caps running around doing corporate tourism. You need to learn to program, and you need to learn more skills. So the ample supply of people who want to buy, but very high demand of people who can short. So think about your career. If you want to be in the alternative space, learning to sell short is not a choice. You have to master the skill. Now, what comes with the skill is you will be a natural risk manager. If you learn to sell short, you will understand risk. You will have an intimate knowledge of risk. Because short selling is risky, will make you a stronger, faster, and better investor. The skills that you will master on the short side will help you on the long side. I mean, you know what? I think that ask Rambo. I think he can teach judo to people or Brazilian jiu-jitsu to people on a Sunday school, right? So that's that kind of level. Now, about short selling, it's very poorly understood. thing here is if we were to line up all the books about going, what to buy, how to buy, when to buy, and what to buy, trips to the moon, if we was to stack them one on top of each other, trips to the moon would be a sad ecological reality. You don't need SpaceX. You can walk your way to the moon with what to buy on the markets just by stacking them up. Now, if we were to line up all the books about short selling on a table, there are 14 of them. 12 of them are completely off topic. I know I had to read them. I'm a short seller, so I had to read them to educate myself. If you were to line them up on a dinner table, there would still be room for a delicious Cabernet Sauvignon or maybe a Shiraz and 2 glasses. Point is, the subject is very poorly understood. It's poorly studied, poorly understood, which if you study it, if you study the craft, you're going to have a natural advantage over everybody else by definition. So we're going to go through all the myths, the classical myth that we hear all the time. The first one is the structural short. I used to work for a fund manager who said, oh, I want to find structural short. Now, every professional investor who publicly claims this looking for structural short is an imposter. Redeem, run, they're walking blow up. They're blow up walking. And let me explain you why. The idea behind this is people running around buying stuff long. They're very busy with their long portfolio. Then they dabble into short selling, fails, they get frustrated. Then they go and do it they tick all the boxes. I want something that has bad rating, a bad analyst rating, bad valuations, bad story, bad fundamentals, bad earning momentum, yada, yada. Basically, I want to find something that I can short and throw away the key. Now, if you think about it, we all know that short selling, we can all agree that short selling is difficult, more difficult than the long side. So if they're busy all day long doing what they love to do on the long side, because apparently it takes a lot of work, how is it logically possible that the short side, which is considerably harder, can be left unattended and unchecked? People who look for structural shorts are imposters who have absolutely no idea what short selling looks like. So Ron, if ever you find anybody talking about that. The second thing is short selling is the reverse of long. Well, the short world obeys its own laws. It abides by its own rules. And my favorite retort to people, oh, yeah. Just going short is just the inverse of going long. I'm like, okay, all right, no problem. Try it. Put your money where your mouth flap. Are you ready to put your money where your mouth is flapping? Go ahead. I'm watching. Go ahead. To this day, zero comeback. Short selling is a different skill set. It requires different rules that we're going to see. The third thing is there's infinite risk on the short side. Wrong, wrong, and wrong. Actually, people who believe that if people don't trust you with their hard-earned savings, if they trust you with their money, for the people in an asset management business, if you watch the money of your clients evaporate and do nothing, just because the need to be right supersedes the obligation, the fiduciary duty that you have to your client, then you deserve to have your name passed down to posterity. You deserve to have your name sealed on a plaque at the bottom of a public urinal for the future generations to piss on it. Let that sink for a second. So there's actually, you need to learn stop loss. The point is, if you're on the short side, you need to learn stop loss. You need to learn to manage risk, and we'll come to that. The third thing is filters. Now, this is an interesting one. A lot of people come with preconceived ideas about short selling. All right, I'm going to short something that is expensive and I'm going to buy something that is cheap. It comes from the GAR, a growth at reasonable price method, where people want to buy something that is at a discount. It's the famous margin of safety. So they believe that the reverse of that is actually shorting at very expensive price. All right, Let's see that for a second. So basically, you would be shorting Netflix and you would be buying GE. Probably not a good idea. Or for instance, if you're doing cyclical stocks are machinery, chemicals, semiconductors, all these. Usually those stocks are very expensive at the bottom of the cycle because the price to earnings, because they don't have much earnings, and they're very expensive at the top of this. They're very cheap at the top of the cycle. So it's actually counter-cyclical. You would buy expensive valuation, you would sell into cheap valuation. So valuation doesn't really work. It introduces a filtering. Another thing that I've seen quite a lot is factor short selling. Now, factor short selling doesn't really work. It doesn't lend itself to short selling. So there's what I've seen quite often is like hybrid with what is that? Pairs trading. Unfortunately, factors is interesting, but Apple is not like a bit of growth, a bit of what is that? Cash and so on and so forth. It's not a molecular cuisine. Apple is a story. Apple is a stock, for instance. The fundamentals. Now we're coming back to the fundamentals. Fundamentals. I used to compile financial statements. I used to be an accountant. So I have a fairly intimate view of that. And my first job in the financial services was around Enron time. So I actually uncovered frauds, quite a few. Being able to write financial statements and compile them, I was able to find them. I found 2 or 3. I found one which was NEC. NEC was a revenue recognition in the lease. It was well, basically they inflated their revenue in the US through leases, recognized revenues. So that was an outright fraud, and I found it in the notes to the financial statements, but it was only uncovered 3 years down the road. So going through this, it doesn't really work. Another good example of that is, for instance, Bill Ackman with the Herbalife. His need to be right was stronger than his obligation to make money. So he ran around, sent letters to the FTC to tell that Herbalife was a scam, Ponzi scheme, and so on and so forth. He lost $1 billion. Too bad. And one of the final myths is what I call the narwhal hunting. So narwhal hunting is people coming from the long side, usually hold the belief that good ideas, good stocks are few and far between. Like they want to have concentrated good ideas that they can ride into the sunset. Now, if you transpose that to the short side, given the asymmetry of information, there's no shortage of news on the long side, but on the short side, it's very difficult to find information. Like companies are notoriously introvert with bad news. There's no budget freeze on a good PR, but there's always like omerta, silence on bad news. So with all this, if you think that on the long side ideas are few and far between and you're a whale hunter, if you transpose that to the short side, you'll have far fewer ideas. So basically you'll be hunting unicorn whales. You'll be running around the Arctic Circle hunting for those elusive whales called narwhals. The short side doesn't work like that. It cannot work like that. And this is what will come to the next thing, which is the outcome quadrant. So this is an important part. This is how we human beings define what we do, by the outcome. So when you create a strategy, in theory, you create a strategy, you have true positive and true negative. Everything's fine. Now, with true positive and true negative is at the conceptual space, everything works fine. Then you take your strategy for a spin, and all of a sudden, first encounter with reality, the first encounter, when theory has its first, no theory has survived its first encounter with reality. Boom, you have false positive. You thought you had the signal, and unfortunately it doesn't work. So the next reaction is, well, I'm going to reduce the false positive. I'm going to impose another condition. So you marginally reduce the false positive, you increase your true positive, and so on and so forth. And then the dance goes on and on and on. Basically, what happens is, all right, let's say it basically to give you, let's say for instance, okay, I'm going to short something that is expensive. All right, so you're going to start shorting Netflix. It doesn't really work. Okay, I'm going to start something that has I don't know, above the 200 range, or I don't know whatever it is. You're going to start increasing conditions. Let me give you a practical life example. Let's think of it as dating by checklist. So originally, there we go, true positive, true negative. So what happens is you're going to increase the number of conditions. And dating by checklist. Let's say, all right, I want to date a lady. All right, good. There are 3.5 billion of them. Congratulations. All right, I want to date them between the age of 20 and let's say 50. All right, that reduces to, I don't know, 1.5 billion, something like this. All right, I want to date within 2,000 kilometer or 2,000 kilometer radius. All right, that reduces to 1 and so on and so forth. I want to date them above 1.75 centimeters. All right, that reduces to 500,000. I want to date a rich, single, yada, yada. Okay, that reduces to 100, and so on and so forth. So what happens here is you have something that is called, well, you keep on reducing, well, you keep on adding conditions, you have all these false negatives, which means that you have the desired outcome, but you don't have a signal. Your signal engine machine stays mute. So what this is something that I've seen quite often with short sellers is, even in 2008, I remember there were brokers, but we can't find short ideas. Like, dude, the market's melting. Lehman just collapsed a couple of weeks ago. I think there's no shortage here. No, but you don't understand. There's there's no good idea over there. There always is. As a matter of fact, one question for the audience to make sure that you're not entirely asleep: how many underperformers do you think there are today in the S&P 500 as of today? We're October 10th. How many? Just if anybody has an answer, please go ahead. Any answer? 100? Yeah, that's a good one. 150? Yeah, we're getting there. Let me give you the answer. This chart is the number of these are outperformers, single count, and these are underperformers, single count. So these are days in the market, and this is what the S&P looks like. So every day you have roughly half the index outperforming for half the index underperforming. And this is the method that we're going to see. This is the essence of the course. What I'm trying to say here is this course is not about trying to impose conditions to narrow down. This course is about identifying underperformers, outperformers. You want to buy outperformers and you want to short underperformers. It's not very difficult. This is the current number that we have. Now, how are we going to do that? And this is what the promise of the course. This is what it looks like. So, as I said before, I want this course. Really wanted to write this course for. This is the promise. This is really what I wanted, to pack as much value as I can. So you'll be able to reclassify your universe within 3-4 minutes. So typically you arrive at the office in the morning, you push the button, and within 3-4 minutes you'll have this. You'll have, all right, these are my outperformers, these are my underperformers every single day of the week. It's not bad. Second thing, you want to have a stable regime definition. So the last thing you want is to have a career politician kind of regime definition. One day it says yes, the next day it says no, and the third day it says maybe. You want to have something stable on which you can articulate a strategy. And you want to have something that is non-invasive. And the method that I'm about to teach you is completely non-invasive. It works with fundamental people, it works with quantitative people, it works with technical people. It's just something that you add, and we'll see the stats later. The bottom and peak out. So the other day I was having a coffee with an ex-colleague of mine. He babysits a big pension fund somewhere north of 3 USD yards, or about 3-4 billion. It's fairly big. And I was explaining this, and he smiled. Well, I mean, we've been long-time friends. He smiled. He said, "How soon can I get that?" Because you'll be able to identify stocks that have bottomed out, and is a pure long-only fundamental traditional cat. This gentleman, that's what he does. But he loved the idea of being able to identify stocks that have bottomed out when the street is terminally negative and they start to outperform. And we ran through a bunch of stocks that he wanted to see. The street is negative, earnings is momentum is negative, sentiment is negative, yada yada. And he suspected that those stocks would have bottomed out. And running the script, we saw that. And similarly, he said, "Oh, I think that these guys are a bit too much euphoria, a bit overpriced, and so on and so forth." So we looked at them, and fair enough, 2 out of the 10 he showed me, 2 out of the 8 he showed me had peaked out. So this is an objective method. This is something you'll have. Idea generation. Now that is a big one. Everybody wants signal. Now let's go back to that chart. This is how many signals you're gonna have. Half the market. So typically, within a month after you finish the course, you'll be running up to your boss. You'll be walking up to your boss. "Hey, boss, I got another bunch of ideas." You'll be like, "Einstein, slow down. Within a month, you gave us more idea in a month than we have to money to deploy over a year." So literally, you'll have the comfort with the stuff that you learn in there, and this is a promise. You'll have more ideas than you will ever have capital to deploy. You'll have a high quality problem. How can I deal with so many ideas? And do not hesitate. If you have questions, if you want to have clarifications, please do ask questions. The next thing is you'll have a screening. Now the screening is this is a, where is it? Should be somewhere around here. Oh no, so a bit. We'll go through that in detail later. The screening is basically you'll be able to press a button and have everything you want. Then we'll go through strategy definition. So how to define a strategy. This one is not going to be complicated. And again, the idea is to give you the building blocks of how to define a strategy. What are the questions you need to ask yourself? And an interesting one is stop loss. Being a short seller, my belief about short sellers, it's all about being able to how to define a stop loss and how to honor it. Everything else is a nice coffee kind of conversation. Everything else is just secondary. We'll backtest this, and then we'll do optimization. And I'll give you 3 risk metrics. Now remember, we are on the short side. The environment does not cooperate. We'll test for robustness. I mean, there's only one time where I roll my eyes at people is, "Oh, I've backtested and I have a Sharp of 2, yada yada." Oh, come on, please. We'll backtest for 4 specific things. We'll backtest for drawdown, where we'll use metrics that test drawdowns, the metrics that test whether your mean reversion or trend following strategy works, and then use metrics that test for frequency of trading. All those packed into 3. Then we'll move to my favorite topic, which is position sizing. We'll have a few libraries, like a few ideas, money management, and then we'll conclude with a aha moment. Okay, now let's go. Quicker. Let's go down to the core structure. We're going to move through here, and I'm sorry, I apologize for not being really tech savvy. So this is a bunch of photos. Maybe we're going to put them into a, what's that, how you call it? PowerPoint, yeah. But this is a bunch of pictures that I've taken for the source code. So the first thing is we're going to go to the relative series. The relative series is this. If you trade multiple markets, let's say you trade all Asia or Asia X, you're going to have ringgit, you're going to have rupee, you're going to have Hong Kong honkies, you're going to have Singapore dollar, you're going to have Japanese yen, you're going to have Korean won. You're going to have a lot of currencies. How do you put them on the same plateau? Then let's say you do MSCI World, you're going to have all currencies from all around the world. So you need to be able to restate them in a single currency and a single market so that you compare apple with apples. So let's see an example. For instance, these are like automakers, Ford, GM, this is a tech stock value. This is an auto stock valued as a tech stock: Tesla, Toyota, Nissan, Honda, Renault, Volkswagen, Fiat, Maruti, Tata Motors. So you can see makers from all over the world. This is in absolute and local currency. There's not much information there. Now let's look at them in MSCI world, relative MSCI world, and what is that? In USD. So everything is restated, and now you have a very clear definition. All right, this one, what is it? Fiat, not looking good. Tesla, maybe it has bottom. I don't know. I have no idea. And you can see all the other ones. So basically, you can make arbitrage now. You can put everything on the same plate. So the question about this is, all right, let's say, for instance, this one is a short. How can I know with a statistical certainty or reasonably certain that it has bottom or that it has peaked out? So this begets the question of regime. Regime definition is, there are basically three classic methods. So we'll go through two of them, and then we'll look at one that I invented. The first one is basically 52-week or 52-week high, 52-week low. So this is IBM. So basically, every time it prints a 52-week high or 52-week low, this is in relative, of course, then it's bullish. Oh, it prints a 52-week low, it's bearish, bullish again, and so on and so forth. Now, interestingly enough, one apart about this method is it reacts really well in sideways markets. Sideways breakout, it does work well. That's something that this method does well. It doesn't flip-flop a lot in sideways market, and it catches long-term trend. The drawback, as we will see later, is that it lags a lot. As you can see here, it takes forever. All right, moving on. So we'll see another method, which is called the moving average crossover. And this is a classic that unfortunately has a horrible win rate, horrible gain expectancy, which is the moving average crossover. I think this one is 50 and 200-day moving average. This is another classic regime definition. So you'll have the chart make pretty close like this. As you can see, all right, this is Senate, this is Congress, this is Senate, this is Congress, this is Congress, this is Senate. And basically, it flip-flops like a career politician. When things go sideways, it flip-flops like a career politician. So you have whole Washington here, and you have all country politicians. And this is the Brexit, basically. This is, so one solution that people have is, all right, it doesn't really work. So they often use a triple one, which is dual, they call it dual momentum. So a long-term one that defines regime, a short-term one, and a mid-term one that defines entry and exit. As you can see, it's better, but it's still not pretty. And then we'll see this one, which is the floor and ceiling. So how does it work? This originally came from the higher highs, higher low, and I realized that actually higher highs, higher lows has 4 conditions, whereas this one has only 1 condition. So because we're in the market and things are random, stars do not align all the time. How does it work? The idea is, as you can see here, is a dot, and then we look at a low. We look at the lows. If the low is very close to the bottom, then there's nothing happening. It might be a sideways market. If the low starts to move up quite with some distance, 1.5 standard deviation, which is 80% in the cumulative distribution, I know markets are not linear, but 80% cumulative distribution is still a good number. If the low is 80%, there's a 1.5 standard deviation from the bottom, it's worth taking a trade. You place a stop loss. If it works, it's likely to go up. If it doesn't, hey, you have a stop loss. Fair enough, it works. So the strength of this method is when you have big counter trend, oh, this is a bear market, this is the end of the world, da 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 da. This is not when you sell. You actually hand on a high. So you buy at a low, and the regime reverts at a high, or shortly thereafter. So bull market, you buy them at the low, and you exit, you start a bear market at a high, which is, and it's fairly stable. As you can see, it doesn't flip-flop all the time. This is not politics. We're not in Washington or wherever, or France or Brexit or whatever you call it. They're all the same. So this is in relative. Before was in absolute. Now, next thing, we're going to overimpose the moving average. And as you can see, one drawback of the floor and ceiling is if you just use this one without working orders, it might not exactly, it is volatile. As you can see, the moving average still doing its thing, not really pretty. Absolute, relative. Any questions? If you have questions, please. Oh, wait a minute. Oh, there are questions. No. Sorry. Oh dear. Come on. I want questions. Back now. Yeah. Release another recording. Hold on. Just give me 1 second. You just see the slide. Can you hear me? Can you hear me? Hold on. I cannot see the panel. Can we go back to the gone quiet now? Back now. Audio has disappeared. High 95%. Yes, I hear. Yes. Okay. Bottom. All right. Victor. Can everybody hear me? Answer yes. Which are the good selling book you've read? Oh, good question. The good there was one from Alexander Elder, which was not bad at all. Then there was the one that I read from Mr. O'Neill, which was just a collection of charts. Then the Disciples, the one that I forgot his name, like the big one, very expensive one. Forgot the name. I lost $80 on that one, man. That I threw it in the toilet. Fabuzzi, I think. Oh, that was just bad. Then there was the David Henhorn, and can you elaborate on how do I determine? Yes. That's a very good question. Yes. All right, here we go.
Laurent. Can you please speak? Can you please say the entire question so all the audiences can know the answer to it?
Yes. Can you elaborate on how to determine the high and low? All right. So we're going through the code right now, and I'll show you. This is a very good question. So sorry. This is the source code that you'll get. All right. Here we go. So you'll get all the source code. The idea there is we go through swings. Let me show you. Actually, a chart would probably be better. We go through swings. So the swings, we use this formula coming from SciPy. We'll use argrel. We use this function called argrel extrema, and then this is just a time. So the quirk of this function is that it can you elaborate on how to determine swing high? So it looks at a window over 20 days in this case, I think. Yeah, 20 days, and then it looks for high or low, whatever. Now the difficulty with this is that it doesn't reset over time. So we actually have to manually reset it, and then there's alternation built in here. So it looks simple on the outside, but it's actually a bit trickier than it is. So this is how it looks at it. We just use a SciPy library, we alternate and modify the last swings, reset the last swing. So this is how we do it, and you'll have the source code for that. So it's not exactly trivial. And then for the regime definition, we use volatility, standard rolling standard deviation with a DDO of 0, classic. And for this, we have a moving window. So I can explain how the moving window works. Is basically, let me show you. So the idea here is how do we find the swing? Like I said, it's SciPy, and then the regime. The regime, we have a moving window. So this is where it gets really interesting, because let me get back there. Let me get back a little more. So once we have found a bottom, once we have found a bottom here, we consistently look for the highest high. Is it the highest high? Maybe. Is it the highest high? Maybe. Is it the highest high? Maybe. Is it the highest high? So we're looking for a ceiling. As soon as we found a bottom, we use this window to find the ceiling, and we continue to look for a ceiling. And then once we find the highest high, we compare this one, for instance, we compare this highest high versus the next swing. Is it? No. Is it? No. Okay, we find a new high. All right, congratulations. So we compare it with swing. Is it the distance? Is it good enough? Is it good enough? No. Then we find this one. Oh, okay, we found this one, and we compare it with the swing. Oh, is this swing? Is the distance between here and there wide enough? And it looks like it is. The idea behind this is you can have as many swings. Once you find the highest high, for instance, if it doesn't penetrate, if it doesn't go above, it's very simple. A bull market ends when it stops making highs. And when the highs start to get lower and lower and more and farther away, very simply said, the sellers are in charge. That's just it. It's not rocket surgery, seriously. Programmatically, it's a bit more complicated. Conversely, when the market has tanked and tanked and tanked and tanked, and then it finds a low and it starts to print higher lows, and farther away, and they don't have to be consecutive. As you can see, they do not have to be consecutive. When the lows are higher and higher, obviously at some point what we're going to have is we have a, so Mark, how you doing? Mark Bronte, quiet. Sound is good, that's better.
So Laurent, I have a question in front of me. So the question to the speaker is it not a concern to you that your broker can see your stop loss and take advantage of it? And the second part to it is how do you set stop loss so that it does not get active by excessive volatility?
That's a very good question. Thank you very much. So, all right. So number one, that's a very good question. Thank you very much. Who asked this question? So I can thank the person who asked the question, because it's an amazing one. Number one, as you see, all the signals are taken in relative terms. So all the signals that you have, they're like in MSCI USD. So yeah, you can't even put those stop losses on your broker. Like, try and tell, hey, listen, you go on your exec desk, on your trading desk, hey, can you just buy me like 500 shares of MSCI USD Toyota? You're guaranteed to elicit comical faces on the trading desk. Like, what? So if all the stop loss and all the price action is maintained in relative terms, by definition, you cannot stall them on the broker's side. Number two, about volatility. And being a short seller, trust me, it's all about stop loss. So here, for instance, this is where you found a peak. This is where you found, oh, this is the swing where I found it. Well, logically, you put your stop loss just a little bit above. And guess what? It crosses. So far, so good. Goodbye. Next. Same here. This is where you find, and this is important to remember it. This is where you place it. Then you need working orders. It's just one thing also that is important. We don't, and this course doesn't get into that. I believe that this course is like foundational, like the first, what is that, like beginners to intermediate, but it is not super advanced short selling. So once you place a stop loss, this is not all in, all out. You need to work your order. Like, let's say you enter here, around there, you're gonna take some money off the table. One rule of thumb: every time you short and it works and you feel intelligent, it's time to cover. It is time to cover. All right, and next question. I want to have, which time frame is considered? Didi, that's a very good question. Thank you very much. So which time frame? Any time frame you want, really. Really, I mean, this is agnostic. You can trade it on 2 minutes, you can trade it on 5 minutes, you can trade on weekly, you can trade on daily. Actually, we're looking at in our work, we're looking at a 2 minute, and we can see the exact same pattern that we see across the board. So yes, no problem. Very good question.
There's one by Andres. He's asking, can you explain the so-called game of two thoughts and how do you define portfolio turnover?
Portfolio turnover. All right. You want the formula for portfolio turnover? So the turnover, the turnover is the absolute market value times AUM. No, divided by AUM. That's it. I think the absolute sum of market value of traded value times divided by AUM. I think. And the game of two halves. You said? Oh yeah. Oh yeah, that's very simple. That is a very this is something that I find it kind of cool. Is okay. We're going to talk about gain expectancy, but if you want to talk about it now, well, right. Gain expectancy is this. This is also something that you'll have in the course. You'll have a whole bunch of formulas. Good noise. Rolling. なんだ。じゃなくて average good day. Here you go. So gain expectancy is, this is the arithmetic gain expectancy. This is the win rate times average win plus loss rate times average loss, right? So the game of two halves basically states that if you have a distribution of, we're going to talk about this a bit later, but if you have a distribution of gains and losses, if you keep your losses at half your average win, if the average losses are every time your losses go to half your average win, you just halve the position. That's all you have to do. That's all you have to do. You calculate your average win. Every time your losses go to half your average win, you cut the position in half. Now, what's going to happen? Mechanically, your gain expectancy will go up. That's all it is. That's all it is. So this is average gain this is arithmetic gain expectancy. George is the geometric gain expectancy. You have Kelly, and you'll have a whole bunch of formula. You'll have SQN, yada yada, the grid, and so on and so forth. Kalmar. So we'll talk about that a bit later. But that was a very good question. Any other question? If you have questions, please ask me and I'll answer. So these are the three regimes that we talk about that were considered, and this is the cumulative return. So as you can see, Tesla has not been kind to anyone in over the last 5 years. This is the cumulative drawdown, still not pretty. And this is the trading frequency, the number of times that the regime changes. Now, this is interesting. I mean, Tesla has been particularly unkind to everybody, but what you want in general is to have a stable regime. To give you an example, moving averages that we saw before, it flip-flops like a career politician. So you're going to be long, you're going to be short, you're going to be long, you're going to be short, and eventually what's going to happen, you're going to start doubting your system. It happened to me, it happens to everyone. First time is like, all right, you take, no, it's not working. Iminashi, no problem, it's just a system. Second time, no problem, it's just a system. Third time, no, forget it. You want to have something that is stable, that you can trust. It doesn't have to work all the time, but it cannot flip-flop. If you have, in the course, you'll also have this thing, screening. So let's look at it. I can't see it because there's a panel. So yeah, I made a copy of that today. So you have Tesla, it turned bullish. For the Tesla lovers over there, screamers, forget about it for now, but it's working. G, obviously, it's not looking pretty. Apple is working. IBM, yada yada. IBM is turning bullish, you know. GM and so on and so forth. So you'll have something that does that every day. I'll show you what it looks like, because ever since I wrote I have integrity. I know. I work in the financial services and I have integrity. Yeah, I know. But I couldn't deliver something that I don't believe in. So I've tracked signals day in, day out. This is the stuff that you're going to get. So you're going to get, I mean, not this particular stuff, but it's exactly the formula that you're going to get. And I've tracked it ever since it was written. So I've run it today, as you can see. And this is the number of signals that you're going to get. We'll see that a bit later. Sorry if I get carried away, but I'm a bit passionate. I apologize. No, I don't apologize for that. I don't apologize. After that, we're going to go through strategy creation. So this is not rocket surgery. I mean, we're not going to spend a lot of time on it, but you'll just get the basic principles. So we'll optimize for so the strategy creation is not very, what we want is something stable that defines the regime, the direction is very important. Then we want to have changing from bull to bear, so the signal to entry. And then we're going to have the stop loss. So the stop loss, I think I explained it a little bit earlier, but I hope you'll, if you have more questions, please ask. I can't really see the panel. So these are the functions. Mark Bronti, can you show us a good example of short-selling books? Yeah, I think I answered this one. More questions? If questions pop out, please ask.
So there's one from Asim. What criteria are you using for sorting, classifying the overperformers, underperformers in the chart you showed?
All right, good question. Oh man. All right, outperformers, underperformers is basically the idea there is I look at the regime and bull is 1, bear is -1, and then the sorting value I'll show you. I have nothing to hide for you. I think it's this one. So you can see that the sorting value is regime change date, and then the second sorting is relative returns. That's it. So you get all the sort of. Any other question? Please keep firing.
There's one from Brian. He's asking, can you explain the entries using floor and ceiling?
Good question. God, man, you're smart. All right, the entry in this case, in this one, this particular thing here is just a raw change. So I'll show you how it's done. I'll show you how it's done on this one, not in the short selling course, but in the file that I use to track to see. This is the core engine is the swings that you get and the regime that you get, and I just track it day after day after day. Then I make this and I just track all this. So in this case, it's just a regime change. What I do is I do a diff method to compare the regime of yesterday with the regime of today. That's it. And regime change. That's it. Now, in the strategy creation that you will have here, this is interesting. Again, the purpose is not to deliver something that you go out and trade tomorrow. The purpose is to give you the building blocks to build something for you. So a strategy is basically, there are 3 things that you need to have. The number 1 is the direction. Should I go long? Should I go short? The number 2, you should have an entry signal and an exit signal. Number 3, you should have a stop loss because, hey, you have your entries, your exit, but every now and then it goes off the road. You need to stop loss. It's just a red flag like anything else, right? So the trade direction, we're going to use the regime that we used before, that we saw before. So we're going to use the floor and ceiling, which flip-flop the least. It's more stable. We're going to use it for the direction, long, short. Secondly, we're going to use moving average, something that I failed to mention with moving averages. It's very good for entries and for exits particularly. So we're going to use moving average for entries and exits. And number 3, we're going to use the breakout. Simply, we're going to use the swings as stop losses. So we're going to combine all the regime methods to define a strategy. And you can recombine doing the other way around. You can do whatever you want, but at least you'll have the code and you'll have the ideas behind it. So the 3 things that you need to have a signal is you need to have a direction, regime, you need to have entries and exit, and you need a stop loss. These are the 3 things that you need. These are the 3 building blocks. Did I answer your question? If I answer your question, say yes. So stop loss, this is the function. This is vectorized, but again, I mean, when you program in real time, you'll have to have different programming, but it's just to give you an idea. Then we'll do a bit of performance optimization, something like that. So you'll have, God, it's as ugly as virtue. So performance optimization, again, it's a bit like optimizing for Sharp. It answers the wrong question. It's the right mathematical answer to the wrong question. You don't want to optimize for performance. You want to optimize for robustness. And this is a very strong difference between my world and the world of the long only. So you'll have metrics that matter. And what I mean by metrics that matter, now that we're here, if you have questions, please continue asking.
We have
metrics
one.
that matter.
Okay, should I go? Yeah. We have one from Todd. He's asking, as a system trader, do you always allow your adverse trade to go to stop loss, or do you close early before stop loss is reached? Should I
That's a
repeat
good.
that? Okay.
All right. You're asking about my real life trading, right?
I
All
believe
right. That's
so.
a very good question. Okay. In my real life trading, okay. First of all, we do scale out, scale in, which means that actually these days we do scale out on multi-time frame. But the idea there is stop loss is there, and it depends on if you're using a trading stop loss. It depends on, as far as I'm concerned, stop loss stays there. And the reason why I would close out before stop loss happens is because the system tells me to close out. I do not run around trying to second guess the system, because what happens in this case is you're not trading a system, you're trading your thoughts, you're trading a different system. So if you decide to being an algorithmic trader is like being pregnant. Either you are, either you aren't. But you can't exactly impregnate yourself on Tuesday night because it's ladies' night. It doesn't work like that. Either you trade your system, either you don't. So I used to override every now and then, but I would advise against it, because very soon you'll do it once, you'll do it twice, and it'll become a habit. Does it make sense? All right, let's go back to the metrics that matter. Now, we're going to optimize for metrics that actually are designed to make you survive. So these are hit rate, mean rate, expansive standard deviation, So these are the standard stuff, rolling, average good days rolling, welcome to New Orleans. And then the performance stats, cumulative returns, you have all the formulas, I guess, I'm sure. Rolling losses, yada, yada. And the three metrics that really do matter, Alcer index. So also you have the grit index. So the way to look at Alcer index is, investors are like teenage girls, really. They all say that they want return. Teenage girls, they all say they want to meet a good guy, but they always fall for the same bad boy with a different name. Now, investors say they want return, but they react to drawdowns. And more importantly, they react to drawdowns in three specific ways: magnitude, never test the stomach of your investors. What is that? Frequency, never test the stomach, and then never test the nerves of your investors. And then finally, duration, never test the patience of your investors. Which means that basically you'll have to look at the drawdowns. You'll have to optimize for the drawdowns. And the formula that does it the best is called the Ulcer Performance in the Grit Index. This is something that Martin Pring called the performance ulcer ratio. So on the numerator, you have the performance, and on the denominator, you have the entire surface, the integral of the losses. So the numerator is the numerator is the destination, and the denominator is the journey. The performance you clock divided by how you got there. Now, another one, and this one I did, it's the common sense ratio. You want to hear about that because it's a funny anecdote. So once upon a time, I was instrumental I got Mr. Jack Schwager to come to the CLSA conference here in Tokyo, and I got to see him. I thought, wow. I mean, I shook hands with Jack Schwager. It's like basically getting a blood transfusion from James Brown, or a thank you very much from Elvis. So I could die. So I showed it this risk metric, and he said, common sense. So I went back to the ranch, talked to my boss, and I talked to him about the metric. He says, oh yeah, dude, that looks like common sense indeed. All right, so here you go, like two people I highly respect say common sense, it had to be the common sense ratio. So the idea behind this is you have two types of strategies, regardless of the time frame that you trade, regardless of the asset class, regardless of everything, you only have two strategies. One is mean reversion, and the other one is trend following. Now, you need to focus on the P&L distribution. Mean reversion is basically you arbitrage inefficiencies. Markets are inefficient. Oh, there's no big dropout in the number of people. If there are questions, please continue asking. So you have a high win rate, and every now and then you hit an iceberg. The way to remember this is like the captain of the Titanic at a 99% win rate. Then the second one is trend following. Pretty much everybody is a trend follower. Like when you buy and hold is trend following. You may not admit it to yourself, but that's what it is. You buy on earnings momentum, you're a trend follower. You buy on cheap value, like Warren Buffett, for instance, is a trend follower. He buys very cheap stuff, but it holds it at perpetuity. That makes it by definition a trend follower. People say he's a value guy, therefore he's mean reversion. No, he isn't. By definition, if he holds at perpetuity, is a form of trend following. It might be fundamentals or whatnot. But that's the P&L distribution. You kiss a lot of frogs, and every now and then you have Prince Charming and Princess Charming showing up. So the risk associated with mean reversion is in the tail. Every now and then you have a big torpedo that might sink the ship. So this for mean reversion. So your best risk ratio is tail ratio. For trend following, the problem is after kissing so many frogs, you probably feel the smudge a little bit, and you're probably going to get sick. So the risk is in the aggregate. So for you is gain to pain ratio. Combine them together, and voila, you wake up with. And then you end up with you end up with this. You end up with the common sense ratio, which is basically at the end of it, you'll get all these formulas. So and the formulas, the way they're written, you can actually expand them and you can graph them. It's not just the residual one. So they were made on purpose. It took a bit of time to write this. T-stat is the SQN. We're going to talk about this one. Tail ratio, profit ratio, and this is just profit ratio times tail ratio. T-stat is also called, and the third metric that you need to be cognizant about, here we are. The third metric that you need to be cognizant about is this one, is SQN. So anyhow, after that, you'll be optimizing for that, and okay, we'll be backtesting optimization with metrics, and then finally you have a position sizing library. That's my favorite part. So this is, for instance, G. You'll be optimizing using those three metrics. This is yeah, getting tired. And then eventually, the final thing is this. And I want to leave you, and I think I'll leave the floor open to questions. I want questions. Any questions, please?
Yes. So, Laura, we have quite a few questions, in fact. One is from Amar, which has just recently come in. Ain't mean reversion just two trends at opposite direction?
I'm sorry?
Isn't mean reversion
go ahead,
just... That's it. That was the question. Should I go to another question?
No, please ask the question. I couldn't hear it. I'm sorry. I apologize.
Isn't mean reversion just two trends at opposite directions?
Okay. That's an interesting question. All right. That's an interesting question. All right. Okay. The answer to your question, I'm not going to answer. I will answer your question, but it's at the different time frame. Mean reversion is a trend. Let me give you a very simple example. Let's say, for instance, on a 4-hour, you have a market that goes nowhere, like it's very sideways, yada yada. Then this is typically the kind of market where you would like to do mean reversion because it oscillates. This is the kind of market where mean reversion works well. But if you look, for instance, at the daily trend, it would be like, wow, this is just a consolidation period. It's just making a swing, whatever, high or low, whatever, on either upward or downward moving chart. So What is mean reversion at one time frame could very well be a trend at another time frame. And conversely, for instance, let's say that we still talk about the 4-hour oscillation, then you go down in time, let's say to the 30-minute. And in this case, you could see, oh, well, it is actually going down. It's a bear market. You see what I mean? So on a different time frame, you have different regime and you have different type of strategies that could apply. So the question also about mean reversion is mean reversion arbitrage inefficiencies. And when those inefficiencies persist, they're the birth of trend following. That's probably another good way to think about it. Next question.
We have one from Mario's, which is, how did you discriminate between the two tops around 280, the other marked as a ceiling and the other as a swing high?
Oh, okay. So I guess we'll have to go back.
Yes.
All right, 280. Where is 280? Is it this one, Mario? Which chart are you talking about? Oh, around here, right? Okay. That's a very good question. All right. Since we use volatility, so sometimes, for instance, in very volatile times here, the volatility that we measure here, as you can see, is probably high. So because it's high, it doesn't meet the ceiling threshold. Here, probably, if volatility is, I mean, I don't know, it just calculates automatically, to be frank. That's my answer. But because in here, the volatility might be subdued. So it's just a distance. The logic behind here is it can go sideways, sideways, sideways. Unfortunately, Tesla is not exactly the kind of sideways stock where you can see and appreciate that. But for stuff that actually goes sideways, I've seen it like that thing stays there forever and it's boring. So I hope I answered your question. It's just a volatility, and it's an effect of the volatility. That's the only explanation I've been able to come up with.
We have one
that
more.
Would be.
Sorry. Please continue.
No, go ahead. Ladies first.
How to avoid false negative or positive in real-time trading?
I'm sorry?
How do you avoid false negative / positive in real-time trading?
That's a very good question. Now, that is an awesome question. All right. False negatives is basically you have that is the essence of the course. If you understand this one, you understand the course. All right. The idea behind the stuff that I prepared is I wanted to be as agnostic as possible. I just want to diagnose the regime. I do not want to impose my views. Like, it's just, okay, is it outperforming? Is it underperforming? Do I have a robust method that tells me if it's underperforming or underperforming? So the idea here is to actually reduce this, because the people who put valuations, fundamental, yada yada, at this stage, they increase, they balloon that. But what I want to do is, all right, I want to have a very clear picture of this. How many are performing? How many are underperforming? That's it. I just want to know within that, and then I can go out and shop in there. Now, the next question is, once you know, okay, this is bearish, and let's say what I do is regime change. All I trade is regime change. Now, and we're going to see the win rate later, regime change is not a perfect science. Markets are capricious, but if I have somewhere around 60% win rate, I can articulate, and it's stable, I can articulate working orders and a strategy that seems to work. And we'll go through the win rate later. So I hope I answered your question. If not, the answer is going to come up soon. My favorite part is always position sizing. As you can see, money is made in the money management module. Does it make sense? I mean, up until now, when you design a strategy, we're talking about the signal module. Now, there's another module called money management module. Like, whether you buy $10 or whether you buy $1 million, you're going to have very different outcome. Tourists, they bet the farm. Pros, they milk the cows. So you'll see different outcomes versus different position sizing algorithm. And when I saw that in 2011, it literally changed my world. I became obsessed with position sizing. You see all the stuff that you see here about ML, AI, yada yada, technical, fundamental, yada yada, and it's all cute. I'll give you one anecdote. One anecdote that I hope will make you understand what I'm trying to say is, back in the days, I was running my algorithm across the portfolios of my colleagues, and just what I wanted to do is have them make 1 basis points or 2 basis points, but you compound that over a year, and you jump from the second quartile to the first quartile, the top decile kind of people. And what happened then is I quickly realized that everybody had roughly the same stocks within their top 10, pretty much everybody, but they didn't have the same performance. And not only that, they didn't have the same information ratio. They didn't have also the same, how do you call it? Shit, I forget that one. Not active money, I forget that. Tracking error. They didn't have the same tracking error. So what really dawned upon me is that the primary determinant of performance is not stock picking. They all had the same ones. There was low dispersion of holdings, but there was high disparity of performance. And what made the difference was that the chart that you're looking at. The chart that you're looking at is actually performance. So that was the big aha moment for me, and I hope you'll have that. I try to bake it in the code. I'll show you where. Here, and you'll have a bunch of others over there. So I hope you'll like it. I know it's not really Pythonic kind of thing, but sorry about that. All right, now, like I said before, ever since I've started doing this, writing this code, I kept the tally. So originally, the peaks that you see here is because IEX moved to paying fee. So I have a paying subscription to IEX, but I thought, okay, I'm going to do it on the Yahoo Finance, which is free, and credit to Ran Aroussi. This is me going to France to a wedding, getting super drunk, and not being able to keep tally for for 3 days. It was not possible, and a bunch of other things. But roughly, day in day out, you'll have probably 4 or 5 ideas. This is S&P 500. This is the performance. Forget about the performance. It's not really important. I mean, it's just like I take a lateral, like axis one, kind of sum of all the cumulative returns. What is interesting to see, so the methodology here is I track signals on relative, and then it's just regime change. And then I tally the cumulative return since the stocks got in. So as you can see, this is what it does. What is interesting to see is that it's quite responsive to the market. You can see the win rate. This is the algo that you're going to get, basically. You can see the win rate. So, oh, yeah, I forgot. Here's the best way to look at it. So you can see the win rate on the bear side. You can see the win rate on the bull side. You can see the total win rate. So it's not bad. Like I said, the method is non-invasive, so it fits very well with what you're going to do. Then after that, you can see the outperformers. You can see the underperformers on the bull side. So that's it. Yeah, the outperformers, cumulative, like as you can see, the bad ones got in, obviously not working, and there's no stop loss. In this case, I just measure regime change, so there's no finesse. It's just the raw signal, no transaction, no whatever. It's just to get the raw numbers. I didn't want to impress. I didn't want to put any bias behind it. Questions? This is the bears. Worst bears? Oh no. Sorry. Questions?
Okay, so there's one from Peter. Okay, there are actually two from Peter. The first one is, how do you know when or if a system is broken, and how do you decide if it's broken? The other question is, sorry, I'll just complete this. Do you use variable position sizing for per trade basis, or all trades have the same expectancy?
That's a good question.
I'll just repeat it for the audience to hear it once more, if you don't. Do you use variable position sizing for per trade basis, or all trades have same expectancy?
All right, okay. Well, Peter, I have a bad news for you. I mean, the answer to your question is going to cost you a few $100,000. All right, my job is to do stuff like that. I mean, every time I land in a hedge fund, I do portfolio management system. So when I land over there, people usually think, oh, dude, we don't really need this stuff. I mean, this is how it started in 2003, and they kept it until 2011, and until at which point they had to upgrade up Excel. And to answer your question, all right, to answer your question about variable position sizing, number one is I believe that you should do something like this. Actually, let me show you. No. Where is it? See ya. I believe that you should do an asset allocation by side, like whether you're long or short, by time frame, and by strategy. So you have a three-dimensional asset allocation. This is how you should calculate your gain expectancy for the side, whether you trade long or short, for the strategy, whatever strategies, however many strategies you have, and for the time frame. And if you have on top of that multiple asset classes, you should repeat the exercise for as many asset classes as you have. That's the long and short of it. Now, in terms of position sizing, I use most people, for instance, this is an interesting. This is the answer to your question right there. So I should have put the Kim Max over here, but the idea is to have a convex capital allocation. The idea behind this is most people try to finagle and finesse the right side of the equation, which is the position size, and the size. Whereas I believe it's more interesting to look at how much capital you deploy. Synthetically, it doesn't change. I mean, synthetically, you get the same. You're going to get better results, faster and better results. I hope I answered your question. If not, ask me. The idea here, for instance, you can use whatever Kelly and so on and so forth. But if you reduce capital when you're into drawdown, if you reduce capital allocation when you draw down, it would work as well. But I'm a strong believer in variable. You see, like for instance, something that use geometric gain expectancy or Kelly or mean variance, like stuff that moves over time, rather than the equal weight or the equal equity at risk. You can use equal equity at risk. And the formula, for instance, we have here is something that you can see over there. That is not part of the course, it's part of my work. Something that we have over there, like for instance, when we have a drawdown, equity, tolerance, watermark, trading low, and so on and so forth. I hope I answered your question. Any more questions, please?
Yes, we have one from Arne, which is, can you elaborate on your work on equity surfing?
Equity what?
Equity surfing.
What is that? Can you spell it?
SURFING.
Surfing, equity surfing. I don't understand what it means, but I guess if you're referring to trading the equity curve, then you're referring to that. Equity surfing. Kite surfing, yeah, I can understand. Yeah, I can talk about that all day long. That's what I do too. But equity surfing, I'm not sure about that one. So this one, right? So this is the, okay, I can show you the formula right there. And this is as much as I can show you, unfortunately, because it doesn't belong to me. No, it's not there. But the idea there, I used the peak equity times an oscillator, and I use convexity. That's it. All right, next question.
Okay, just hold on. Even I'm looking for one that has not been answered. Someone has, I think we've answered the one by Mario, is basically assigning a floor or ceiling to a swing is based on time variable.
Correct.
We've answered that, right?
Yeah, I think so.
Okay. How do you okay, we've also done when the system is broken. How do you decide when and if a system is broken? Do you take it offline or do you reduce size?
That's a very good. Actually, I wish I had a formulaic answer for this one. I wish I had a formula. Well, okay, yes, I think I do have an answer for this one. Number two, I mean, the thing is, it goes back to how did you test your system in the first place? What was the set of data that you use to test your system on? See, my belief about testing system is that this is the one time where you should commit infanticide. You should kill your baby as early, as brutally as possible. So if your intellectual baby survives waterboarding, drowning, electrocution, beating, then maybe he has a chance of survival. And the idea behind this is like, for instance, let's say you have a breakout system or whatever system, like momentum system, that you've tested only in bull market. Let's say you go long only. What would happen is that it would react very well, but not all markets are bull trending long. See what I mean? So it depends on the condition. It depends on your assumptions that led to the creation of the system. And the more complicated the systems are, the more likely they are to break. That would be my answer. So one way to look at it is to change the data set that you tested on, to change the time frame that you tested on. My belief is that you should also, let's say for instance you have a system that trades on daily, you should try and test it further down the road to see if you can sustain a positive gain expectancy. This is something that we not talked about, but SQN, system quality number, or it's a T-stat. It's this risk metric focuses specifically on trading frequency. So if you focus on trading frequency, you should be trading as long as you have a positive, you should be trading lower time frame as long as you keep maintaining a positive gain expectancy. So one thing that I always encourage people to do, number one thing that you can do to make sure that your system works, design it for the short side. That's the best thing you can do. If it survives the short side, trust me, I think it'll cruise on the long side. Trust me. That's a very good way to design a short system. And it has another benefit, which is symmetry. If you design for the short side, then the rules that you design will have to work on the long side. So symmetry is also something where you can save a lot of time and save a lot of money. Don't worry. You'll be able to draw all these pretty charts, like all these kind of stuff like that. Yeah, you'll be able to do that too. All right, next question.
We have another one from Todd, which is please elaborate on position sizing in your algorithm.
All right. Unfortunately, I didn't have time to write a full library on position sizing, but the idea behind this is, all right, this is the final thing, and I'm glad you asked this question. It's a good question. I mean, if you don't get a ha-ha moment after that one, after like going through the course and don't get a ha-ha moment, you have my deepest sincere apology. So this is the code that we'll go through. All right, here it is. This is GE on a relative basis, trading 100, using also, of course, the floor and ceiling, and trading 100 and 130 days, what is that? Crossover, just for entry and exit, with a stop loss, yada, yada. So here we go. Let's go through the code for that one, and you'll understand. I mean, and this is the least Pythonic code of all the entire thing, so I apologize for that. So in the optimization, we just took the high score. Okay, then we have the signal. For everything where we have NA, we just replace by 0, yada yada. We have position, yada yada. Then we define the stop loss, which comes from. So we start with the same capital. We use constant risk, which is equity at risk. You'll have the formulas right there. Don't worry. You'll have all the formulas right there. You'll have them. And then we use the close one day, so just a difference, just to measure the close. And then we define the position sizer, so we define the column for each one using each position sizing algorithm. So far, so good. We replace all bunch of NA. So man, this is so not Pythonic. Then we initiate this. Then we go through a loop because we iterate to calculate the equity. This is the part, it's not Pythonic. We iterate to calculate the equity curve at each point. So it's basically the previous one and the close times the round lots. So we do. So the idea behind this is we start with the same capital, same signals, and we just iterate over the position sizer. So that's it, to calculate the equity curve. And then we compare the equity curve. That's it. That's it. And this is the discrepancy that you get over time. So money is made in the money management module. This is very, very important. Next question, please.
So, Laurent, as we've already reached the duration of the webinar, we'll be taking 2 to 3 more questions, and then you can take the time to speak about the course, and we'll share the special discount code that we have for all the people who attended this webinar. So, one of the questions is, how and why is long and short different, and why is long more profitable?
How and why is okay. Number one, prove that long is more profitable. Prove it. Now, here's the thing. Well, long and short are different. The short side is considerably more volatile, and if you short, you need to basically borrow stocks, which has a cost. There's no free right there. So it is more difficult. It is more technical. It is a more complete scale. And number two, about all right. Do you know this company called Atari? Do you know this company called MySpace? Do you know this company called Lehman Brothers? Do you know this company called Kodak? Do you know this company called WeWork, Uber? They haven't listed yet, but don't worry, they'll go bankrupt too. So the idea there is that for all the Apple that we have Commodore, Atari, yada yada, Sinclair, you name them. There's a very narrow path to success, but there's a big boulevard of failure. If you look at the S&P 500, for instance, out of the original S&P 500 when it was created, only 2 companies have remained in the index. There have been 1,486 companies. If you look at, for instance, pharmaceuticals, 80% of the trials doesn't work. That's a lot. So shorts, it's actually easier to bet on human failure than on their success. Now, it's not as glorious. You don't clog the 10 baggers and so on and so forth, but you get a lot of losers over time. I mean, if you work in the financial services, you probably know that. Next question.
So this is the last question we'll be taking for now. Are you using dynamic or static position sizing methods?
Oh man, I hate intelligent people. Dynamic. Yes, dynamic. Everything's dynamic in what I do. All right. Okay, the question you're asking, actually, the answer extends far beyond the scope of the course. Everything I do is dynamic. So, for instance, we have a dynamic Kelly. We have here. Everything is dynamic. We have a dynamic Kelly. We have dynamic limits and so on and so forth. These are dynamic limits. Everything I do is dynamic.
So one question is, how can we access the notebooks? I think this is when you buy the course, when you enroll for the course, you'll have access to all the notebooks. There's another question, which is, just hold on. How would mixed trend following and mean reversion as a combined strategy work? How did you come up with the thought process?
Somebody is reading Quora. All right, that's a very good question. So the question actually, okay, hold on. Let's go back. All right. Man, this is an encore. I don't get encores very often. Okay, this is the mean reversion, right? So the mean reversion, basically what happens is you arbitrage. Let's say for instance you have you think that the market is bull, and then you buy when it tanks, you buy the dip. What you're going to do then is as soon as it reverts a little bit, you're going to take money off the table. You're going to clock one of those. It's a scale out. Then, but you're still long the overall, so you're going to stack in position, get in, take a little bit of money out, and continue to go long. So this is how you're going to. because the holy grail, let's look at the advantages of both strategies. What you have here is you have a high win rate. So you're going to compound small profits, small profits, small profits. You're going to compound a lot of them. And you take very little risk. Oh, I need to share a screen, right?
No, I'll be sharing it for now. You can continue, please.
Okay, so the idea there is you have the two distributions, right? So the distribution of classic mean reversion is you're going to clock a lot of small wins. And then the trend following, you want the big wins. So the idea behind this is you're going to buy the dips, for instance, and then as soon as it goes up a little bit, okay, take money off the table, reduce the positions. Does it again, rinse, repeat. So you keep like a little bit of the original, a little bit of the next one, and so on and so forth. This is how you do it. Now, how you do it, this is one way to do it. Now you can do it across time frames. This is what we're doing now. I won't elaborate on that, but this is also very interesting. So this is how you can combine, because the attributes of a mean reversion is that you quickly compound, but you don't go very far with it, but you have a very high turnover. So this is really good, and you have a very high win rate. So you can actually use your, for instance, Kelly or whatever dynamic position sizing algorithm that you have to actually supersize your positions. Something that you can't do with trend following. Now, on the trend following side, the difference is, the difference is you have a very long tail. You have a very long right tail. So you're going to clock the 4 baggers for like 10 hour, 8 hour, and 9 hours kind of thing, or even longer than that. But you're going to have the nasty left tail. So the way to combine this, unfortunately, it's bound to happen. The way to combine this is to have this kind of the third one. This is the stuff that we're trading to use the what is that? To use the mean reversion to clock small profits, reduce risk, and let it go. And this is something that I learned on the short side, because I'm not exactly smart. So when I see something tanking and I feel good about myself and I feel vindicated, I'm like, time to cover. Something is a short squeeze around the corner. Literally every time I felt, yeah, man, this is good. Almost every single time there was a short squeeze around the corner. So this is how I came about. It was purely empirical. Next question.
We have one. What's your criteria for taking profit? And also, I'll be sharing the presenter right back with you, so you can share your screen.
All right. Stop recording. Okay. Show screen. No. Share. Wow. So the in profit. Okay, the question you're asking is actually that's a very good question. Is strictly gain expectancy. Actually, I can show you that it's a Bayes entry on gain expectancy. Wow, man, that's a very good question. You can solve it by linear algebra, or you can do Bayes entry. That's the long. So the idea that this thing that was the question that I was answering before is this: when you have a mean reversion, you're going to compound, you're going to clock a lot of small profits, but they don't go very far. As you can see, it's a very short right tail, and but you need to have a stop loss. So like I said, buying the dips, you set a stop loss, boom, it goes up a little bit, thank you very much, rinse, repeat. But you still long the overall or long or short the overall position that you have over time. So by doing this, you'll still have those ones, but the difference is by adding mean reversion to it, you'll have this shape. So in the overall, because the mean reversion has a very high win rate, that will enable you to oversize your positions. So you'll still clock the big ones, you put a stop loss in it, and you do the mean reversion. This is how you do it. So basically you do mean reversion within a trend following context. I don't know how to do the trend following within a mean reversion context. I guess actually no, I do know how to do it. You do it across time frames, but it's an entirely different conversation. And this is like, I mean, I don't want to spend 4 hours talking about it, because it would get us down a very beautiful rabbit hole. Too late for the red pill. Next question.
We have someone who's asked us, what's your favorite wine?
Ah, finally. Ah. Finally. All right. So while we were talking, I was downing a little bit of my friend Thibaut d'Espagne. It's Montpellier. It's not my favorite one, I must say. My favorite wine, and that's absolutely amazing wine, is I love the Côte Rôtie, but my favorite wine in the world is a Tertre Haute Boeuf from my friend François Midjaville. Absolutely amazing. This is a Bordeaux. This is poetry. I mean, people go to Mecca for pilgrimage. I go to Bordeaux. I mean, you know, and in Bordeaux, we always end the week with going to Tertre Haute Boeuf, and this is amazing wine. I hope I answered your question. Otherwise, I would go for actually, I would go for the Shiraz Viognier, the fantastic Shiraz Viognier in South Africa. Amazing stuff. Yeah, it's pretty much it. The Viognier in France, amazing stuff. Next question, please.
Yeah, I think you've made everyone a little bit thirsty right now.
Cheers.
Okay, we have a question which is, can you address the fragility of systems over time? And what should you avoid when creating a plan with fragility in mind?
All right, good question. That's trust me, if I had the answer to this question, I wouldn't be where I am. Okay. It goes back to the state of assumption. Like for instance, the stuff that we're doing now, it is like absolutely bare bones. So my belief, and it's a very strong L belief, is complexity is a form of laziness. So as the great Chinese philosopher Bruce Lee, Bruce Lee used to say, perfection runs into simplification. The idea is the more stuff, it's not like a Chicago pizza where you stuff shit on one top of one another. It's actually you see, like my experience with people who have very long and beautiful track record is that they have a very clear, they're not smarter, they have smarter training habits, and they have very simple system in general, systems that have survived the bull markets and bear markets, and over time they tend to purify it. There's a very good example for that. His name is Pablo Picasso. One day a lady walks up to him and says, "Hey, can you draw me something?" Pablo starts drawing something, like 3-4 lines, and like, "Wow, wait, it took you 30 seconds to draw this." "No, lady, it took me 30 years to get there." So I guess I answered your question. So the only way to fragility in mind, use the metrics that I mentioned before, because they test for robustness. Then look back at, rather than trying to add another pepperoni, pepperoncino, and more stuff on the pizza, try and see if you can do without. And very often, more often than not, the way to solve a problem is not at the level it happened. Let me give you a very simple example. Let's go back, for instance, to this. I'm gonna put my glasses on. Do you mind if I have a little sip of Bordeaux, because the night is not young anymore. Let's say we have something like this. Something like that. Yeah, that would be pretty. So as you can see, it flip-flops and so on and so forth. So the classic answer would be, okay, I'm going to slap another moving average. No, not this one. Probably this one. Yeah, I'm going to slap another moving average, and then here we go. No, the answer that you might, if you look at it from a gain expectancy perspective and all the metrics that we're talking about, you might want to be considering, oh, wait, is it, because if you look at the gain expectancy as the final outcome that you need to have, the equation that you need to solve, that is the solution in the signal or is the solution in the position sizing? See what I mean? Let's say, for instance, first time around, oh, it's working. No, it's not. Oh, okay. Senate, Congress, Senate, Congress, Congress, Senate, and so on and so forth. If it flip-flops like a career politician, maybe you should start thinking about sizing differently. So the answer to your question is here. It's a few $100,000 away. But I'll show you the chart. Where is it? I don't know, it's somewhere down there. It's here. You need to amortize the risk. Pyramid, that's one. No, yeah, sorry. But the idea is to amortize the risk over time.
I hope I answer your question. I mean, this is the only way I've found, but they might, I mean, smarter people find smarter ways. Next question, if there is any.
Two users have asked. I think you'd answered this before, but if you can share it in chat, that would be great. Which are your favorite books, or which books would you recommend for short selling?
Okay. So the David Einhorn, fooling some people all of the time and something like that, is a marketing exercise. So it's a very good marketing exercise, but it's not a book about short selling. There's nothing. There's also The Art of Short Selling. That one is anecdotal, and it's, I mean, I'm a CPA, so I cringed a lot when I read it. But this is the first I read, and I thought it was interesting. But looking back over time, it's not scalable, it's not replicable. Again, I liked the Disciples, Gilles Morales, I think that was the best one. The Disciples of O'Neill. Gilles Morales wrote a book about short selling. Well, that was good. Alexander Elder, but again, it has a very much technical analysis bent. So I'm not exactly sure that this is what you want. O'Neill was a chart fest. I read the Frank Fabozzi book. That was academic. That I lost money buying that book. The value I got out of it, I lost money. That was pretty much it. The rest was pretty much like I read other stuff and it was like too scammy for me. But I'm sorry about this. I mean, it is also bent on how you approach short selling. If you approach from reading balance sheet and financial statements, you're going to be focusing on the balance sheet side and the note side when other people are focusing on the EPS. So it's not scalable and replicable. So you'll run into a problem of scalability. I would recommend you. I have a Quora. I write a little bit on Quora. You can go on Quora and trying to read the stuff that I do, and just look around the internet. But frankly, the literature on short selling is so scarce. I mean, there's nothing, as a practitioner, there's nothing that I really love. There's nothing. The stuff that I would highly recommend is Ventop. Ventop is very foundational. Like, you need to read Ventop. Do Jack Schwager as well. Michael Covell, my friend Michael, he's a good guy. Love Mike. Man, he does crazy yoga. That's it. I read Mark Minervini, but he doesn't short. Yeah, that kind of stuff. Other questions, please.
Okay.
We'll wrap it up.
You're sure, right? Because Laura, I understand that it's getting really late out there. So did you find we have, I think, 2 to 3 more questions to go?
Okay.
Yeah. We have one by Jackie. How many strategies should you have before becoming a full-time trader?
That's all right. Okay. Now I'm going to quote this great Chinese philosopher, Bruce Lee. So Bruce Lee used to say, I do not fear the guy who's thrown one kick. Do not fear the guy who's thrown 10,000 kick one time. I fear the guy who's thrown one kick 10,000 times. So the problem that you have about developing multiple, what I would, if I would encourage you to do so, is look at the commonality. Like, for instance, originally I thought, okay, I'm going to do main reversion on the one hand and trend following on the other hand. Then I realized, wait, how can I combine them? Then now at the moment, I only trade one strategy, which is a scale-out strategy, but I trade it across multiple time frames. And the idea behind this is, if you trade too many, the problem is that you'll be running into is asset allocation, and that is a complicated problem. You'll need to have an asset allocation algorithm that will load all of them, and that is complicated. This is not a simple answer. I mean, there's a simple mathematical answer to that. It's also in the stuff that I do, but it's not. You have a finite amount of money, and if you have more than 10 strategies, you have 5 too many. If you have 10 strategies, you have 5 too many, really. And next. All right, one more sip of Bordeaux. Here we go. Next, please.
Okay. All in, or do you stack positions?
All right. Okay. All right. The question is about scaling in, scaling out. Okay, so we're going back to this chart. And this is a really important stuff. So here, basically, what it says is this is an advocacy for scaling out, basically. So scaling in, scaling out. All right. The stuff that I do now, I scale out only. I scale out only. I scale out, but trading multiple time frames, it is synthetically on a consolidated basis. It's scaling in as well. I can't elaborate on that. I won't elaborate on that, but it's a fairly, because that is, if I had to answer that one in full detail, it would take us about 3 hours. So let's leave it there. But I would recommend you scale out to reduce risk and scale back in to, it's basically a question of probability, sliding probability. If the probabilities are in your favor, you should get in. If the probabilities are against you, you should get out. That's all I'm trying to say. So scale out, scale in, but it's not all in. It shouldn't be all in, all out, because what you do implicitly is rely on the signal, the gain expectancy formula. That's not a good idea. Next question.
Okay, I think. Okay, promise this is the last one. Your course comes with short selling and mean reversion, or just short selling? Do you want?
I don't distinguish between one and the other.
Though I think you can find both on Quantra.
Yeah, you can find both on Quantra. You'll have mean reversion. You'll have. I mean, yes, the stuff that I do is long short. So you'll do the short selling, and as a bonus, you'll also do long. So it's symmetrical. Now, it's how you articulate your strategy that determines. Let me answer this question from a different perspective. All right. What defines a distribution? The distributions are defined not by the entry. Let's look at Warren Buffett. Warren Buffett buys, and then it stays there forever. Other people, they buy, they arbitrage inefficiency, and then they close out the deal. Same stock, different exit. So how you define your exit defines defines your P&L distribution. If you cut short, but repeat it often enough, then you're a mean reversion trader. So the exit defines your P&L distribution. I think that answers the question.
Okay, so I think we're done for the day. But thank you so much for this great session. And thank you everyone for attending. It has just been a pleasure with specifically the Q&A. So thank you, Laurent, for regarding the course that has been authored by Laurent. Please go through the details. Thank you, Laurent, again.
Thank you.
Thank you.
Thank you. Good night. Good night. Bye-bye.